Gold stuck near $1,800. In fact, it's close to 4-month lows. We're joined now by Phillip Streible, Chief Market Strategist at Blue Line Futures. Phillip, thanks for coming on the show. The weakness in gold, a lot of that to do with the strong US dollar.
Yeah, well, we did see the correlation switch where gold and the US dollar were trading together, positively correlated. But once you saw the last 15 and 30-day breakdown in that correlation, they've gone inversely correlated, as well as many other commodities against the dollar. You know, now the dollar is starting to build on these interest rate hike expectations. Also, you've got many other foreign currencies continuing to break down to multi-decade lows, and yields here are holding right near their highs. So a lot of pressure on gold at the moment here. I think that over time, though, I think gold's going to be a better asset, especially in the second half of the year.
Why is that? Why will gold stage something of a recovery, do you think?
Oh, because of the fact that you're going to continue to see this Fed tightening and this hawkishness going into an economic slowdown. U.S. equities are going to continue to sell off more. We should see, you know, the S&P post 32 to 3,500 on that kind of breakdown there. That's where the Fed will pivot after two more 50 basis point rate hikes. They'll pivot to a dovish stance, and then gold futures will catch its bottom along with a lot of other risk assets.
Tell us, let's switch to the red metal here, copper. How are you playing that one right now, Phillip?
So the problem with copper was that you had China, which is one of the largest consumers. They consume 54% of the global copper supplies. They had shut down their economy completely. All their economic data has just been terrible. They just had 2 industrial readings, and they both came out. They were about pandemic lows. So with that lockdown taking place, you're seeing demand destruction out of industrial metals across the board. Now, the way China is playing it is they're using their lockdown measures as a tool to fight inflation. Remember, our inflation was quite low when we were at our maximum lockdown. Well, the U.S. is able to raise borrowing costs, and we're able to, you know, manage things through fiscal and monetary policy, where China, the problem they have is they can't raise borrowing costs at all. And you've already seen a default coming out of bond payments through its 4th largest property developer. So, you know, they are unable to raise rates at all. So their tactic is to use the lockdowns. Now, the lockdowns are set to expire on June 1st. So we'll see what happens. And I believe that type of news is why you're seeing a little bit of a boost up here in Chinese equities, also gold and silver.
That's interesting. That the Chinese, I hadn't heard that before, that this is part of China's battle against inflation. It's not so much a public health thing, or not entirely a public health thing, the lockdowns.
Well, I mean, you know, I look at the strategy that they're using. So they can't raise rates. They can do the lockdowns, and having a zero COVID policy is like, it's just almost impossible, especially with that large size. You know, I mean, I do know people that are still getting COVID right now, but it doesn't seem like, you know, they know the routine. They isolate and they, you know, wait it out. They test negative. They go back to work. That's just the way it is. You're going to have to deal with it. You know, if things do get complicated or a new variant comes out, then, you know, you'll have to take things one step at a time. But the current COVID that's out there doesn't seem to be as life-threatening as before. So I believe that China is they're really trying to flex their muscle. And we're seeing other countries do it as well. North Korea, they had one COVID case, they locked down the entire country. They know that it's a way to curb demand, force demand. If I force you to stay inside, you're not going to be able to spend anything. Prices are going to naturally come down.
How are you playing wheat right now, Phillip? Do you see more upside?
Lock limit up right now. The pool's only about 1,200 contracts, so you saw a lot of liquidation coming into the last USDA report. The story behind it is that, you know, you've got Ukraine, Russia, large wheat producers, large wheat exporters. Okay, they've been completely offline. India said they were going to step up and they were going to fill many of those needs. They were set to export about 10 million tons of wheat. Well, what happened is they suffered a heat wave which damaged its crops. They're canceling some of their offers to other countries here. They're not going to fulfill anymore, especially to places like Turkey and other countries, Egypt, that use quite a bit of wheat. What they're doing is they're focused on their own people, and this is another method for them to try and reduce inflation, stop exporting it. The problem that they have is you have those other countries that need the wheat. They're going to look out in the world market, and the U.S. wheat crop's already tight as it is. We've got dryness in the northern plains. We've got a crop that's behind schedule right now. So, wheat futures could go up. They're back up near those, the levels that we saw when at the height of the conflict. So we could break out from here and go a lot higher.
And just finally on oil, just are you a bull on oil right now, Philip? Sorry, we've only about a minute left.
Surely looks very strong. Any pullback you get, people are trying to secure supplies. I don't think the demand is curbing at all, and you're seeing upward price pressure. We're about to break out through that 110 level, and we could push on back up to 115, 120. I think you got to be a buyer of any dip you get in the oil right now until something structurally changes.